Welcome to We Learn Virtual Learning Network. This is session number 14 of Retail Marketing and the chapter is Financial Management and Issues in Retailing. Topics to be covered are Introduction, Role of Financial Management in Retailing, Structure of Financial Accounting, Key Issues in Financial Management, Budget Planning, Understanding Retail Business as Profit, Budgeting and Resource Allocation Strategy Planning, Performance Measures and Audit in Retailing. Introduction. Financial management is very common and is used by everybody. A common man like you and us does this. We plan our monthly budget according to our needs. For instance, if we have to go for a festival shopping, then in ideal conditions, we plan our budget and control our expenses beforehand in order to avoid any financial shortage. So, whenever we have to go for any shopping or for any occasional shopping or related to any festival, then we plan our budget accordingly to avoid any financial hassles and any financial shortage. Role of financial management in retailing. Retailing involves a lot of finance investment in terms of merchandise, real estate, infrastructure, building investments, human resources, which needs to be managed and optimized for the better operational efficiency and a healthy ROI, that is return on investment. Therefore, it becomes important to understand the various dimensions of finance management as played out in the retail scenario. Structure of financial accounting. The financial of any retail business needs to be established well before the execution. The plan of this financial should cover all the broad as well as granular details and aspects of the business. So it should cover all the major as well as the minor details and aspects of business. Key issues in financial management. Budget planning. Financial planning lies at the core of the retail planning and is divided into two broad subcategories: financial accounting and management accounting. It is imperative to understand that for success of any retailing business model, the most critical aspect is financial planning. Unless and until a person does not plan his or her finances accordingly, then the person faces financial shortage and financial hassles too. Key issues in financial management. It is thus critical for the promoters of retail company to begin their planning process with the following: detailed assessment of financial resources available, effective and timely use of these resources. Mobilizing financial resources is an integral aspect of any business and retail is no exception. So in any business, mobilizing and utilizing financial resources is very important and retail is no exception. While it's a common knowledge that most retailers buy on credit and sell on cash, most retailers, they buy on credit and they sell on cash. Most products, merchandise is available on extended credit terms as well. In fact, an interesting thing to note here is the fact that greater the number of stores, the higher would be the power that retailer holds. For example, if a retailer has a sale of rupees 50 lakhs per month and was getting an average credit of 30 days, his total outstandings would usually be around the same value. In other words, if financial planning is carefully conducted and all the systems and procedures are in place, it's possible to generate surplus cash flow in retail operation. A large part of what would have otherwise gone into paying taxes could be used by the retailer for fueling his growth. Understanding retail business as profit center. Well, the most important factor that supports retailing is cost control. Apportioning the cost is equally important, as has been briefly explained in the earlier section. The success of any financial strategy, particularly in the retail sector, is confirmed by the ability to leverage its intangible assets to the greatest extent by multiplying the same and then apportioning the costs over a much larger network of stores. Profit center accounting is now acquiring increasing significance throughout the global business community, as it has not only proved to be more scientific method of accounting, but it is also able to be more explicitly defining the performance of those responsible for their respective profit centers. So profit center accounting is now acquiring increasing significance throughout the global business community, as it is not only the scientific method of accounting but is also defining the performance of those responsible for the profit centers. Understanding the term profit center. In retailing, the term profit center is significant as it identifies every individual store as a center of generating profit. So profit center basically says a center which generates profit, any retailing outlet or any other outlet which generates profit. Each such profit center would usually have two kinds of expenditure, which are direct expenditure and indirect expenditure. All expenditure that is incurred on the account of the respective retail stores profit centers is termed as direct expenditure. That includes all the merchandise and the overhead costs as well, and the expenditure that is incurred only on account of the respective retail stores, that is the expenditure which is incurred by them, that is known as a direct expenditure. The head office and warehouse of the store, which basically provides all the necessary support to run the store operation efficiently, also incur a major expenditure, while individual centers do not have any source of profit. As such, by an effective formula decided upon by the management of the retail company, thus selects an effective formula to apportion these expenses over the number of stores that the company operates, achieving a true picture of its profitability. So such basically the expenses are basically apportioned and it is distributed to the company stores which the company operates and which gives the true picture of its profitability. In case the creation of a larger chain of stores does help in generating a good circle of low cost which drive higher volumes and which allow the retailer to charge an even lower price, that in turn increases volume even further. In this context, Shoppers Stop can be considered as a best living example throughout India that has been able to achieve this with a high level of success. So it has been able to achieve this, it has been able to generate a good circle of low cost and which has also driven higher volumes, and where the retailer has to charge even lower price, that in turn has increased volume even further. We must not, however, forget that in business of retailing in particular, any company sailing with a heavy load of overheads is destined to gradually sink to bottom of the market ocean. Overheads must be axed and the situation needs to be reviewed every month rather than just once a year. So in business of retailing, any company sailing, that is if it is having a heavy load of overheads, that is destined to gradually sink to bottom of the market ocean, and overheads that must be axed and the situation needs to be reviewed every month. Budgeting and resource allocation. It is by design that we are not perfectly sure about what things are going to turn out in future and plan everything accordingly. The concept of developing a financial model is too based on the same principle. Budget is a term used by accounts to define a detailed plan that is prepared in advance for any future activity and is usually based on the available historical data. So whatever numbers you have to spend accordingly and you have to spend within that. So budget is basically a number, a figure which is decided, of which the shopping will not exceed. It helps retailers to predict as accurately as possible the future performance of the company on numerous parameters, thereby preparing the management decision makers for future. It also offers companies an insight into these areas wherein it must concentrate its efforts instead of spending time on issues which may be less relevant for the time being. Retailers would do well to use this tool in the most efficient and effective way rather than simply treating it as another formality to be completed, as is usually the case. Budgeting can thus be defined as an approach in which the experience of the past information or history of business experience available is used to try and project estimates for future. So whatever evidence is gathered or whatever information of the history of business experience is available, that is used to project estimates for the future. The key output from this whole process of efficient budgeting is to get cost control. There can be two broad heads under these costs, which are namely direct and indirect expenses. The investment has on two parts as follows: variable and fixed costs. Fixed costs are the bottom line expenses that are mandatory for any retailing business, and hence it's difficult to control it, as these are the core requirements to initiate the business. So fixed costs are the costs which are the same every month, they are the bottom line expenses which is compulsory or mandatory for the company to occur, and it forms the core requirements of initiating the business. For example, a store, let's call it K Store, expects that in the coming financial year the sales are likely to go up by a certain level. This should be used as an opportunity by all the departments of the retail store. So if, for example, a case store that expects that in the coming financial year the sales are likely to go up to a certain level, then this should be used as an opportunity by the retail store. For example, sales increase by 40%, then increase in investment should also be there, if not 40%, then in some proportion. This will maintain the financial balance of the store. So the increase should be the same in all the departments to maintain the financial balance. Strategy planning. It is very commonly understood that planning a strategy is done for future sustainability of any operation or model. Strategy is done on a holistic scale and covers all the broad as well as granular aspects of any business model. Performance measures and audit in retailing. There are a few technical filters that are very handy when it comes to analyzing our performance in a retailing scenario. We can have a look on them in the following set of explanations with the terms. Payback period. The payback period is the duration of time required to recover the initial cash outlay on the project. So there are various technical filters that are very handy when it comes to analyzing our performance in the retail scenario. Benefit cost ratio. BCR relates the present value of benefits to the initial investment. Net present value. The net present value of a project is equal to the sum of present value of all the cash flows associated with the project. And in internal rate of return, IRR, the internal rate of return of a project is the discount rate which makes net present value equal to 0. So a discount rate is actually offered which makes the net present value 0, and benefit cost ratio relates the present value of benefits to the initial investment. And net present value also is equal to the sum of present value of all the cash flows. So that was all about finances, accounting and financial planning. These are some of the questions you have to do it yourself. Question number 1, what can be the various factors that affect the financial planning in a retailing business? Explain with examples, and what are the specifications that make retail business different from any other line of business? That's all. Thank you. Happy learning. We learning.